All right, we've been talking about the outperformance of U.S. Treasuries over stocks this year, perplexing some of the top money managers. You know, U.S. Treasuries continue to rally even after S&P downgraded the U.S. debt rating. Now, that was back at the beginning of August. But what if another downgrade were to occur? Hard to believe. It does seem unlikely, but not according to a survey by CRT Capital. Over a third of respondents say the U.S., this is in this survey, could get another downgrade before the end of the year. Well, joining us now with more on the survey is Lyngen, senior government bond strategist at CRT Capital Group. He joins us live from Stamford, Connecticut. Ian, it's always good to talk to you. And this was a shocker to me when I saw the headline on this survey. And you were actually, I got to give us a pat on the back, inspired by a story we were doing. But get into the details of the survey.
So when we went through and asked the question, well, is there an opportunity for the U.S. to be downgraded again? And if so, are we going to see the same response that we saw in August? So you're right. It was about 38.5% of the respondents said that we would see a downgrade by the end of the year. And that number actually increased when you go into 2012. So some believe that it becomes more likely into next year. And obviously, it's all about the ability for Congress to cut the deficit and to really meet these objectives that the super committee has. Now, if they're unable to do it, the thought is that half of the respondents are thinking that the response will be the exact same as it was in August, and the other half say no. And it's not a question of directionality, but it's really a question of the size of the move.
And when you say half think the response will be the same as it was back in August, you're not saying half think, you're saying half from a market perspective think that we will see a market reaction, which really went against most sort of what most people had expected or thought would have happened after downgrade. We actually have a description sort of what, going by asset class, of what you actually think or what the survey respondents thought. So S&P, right, more than half think the S&P will fall 10%.
Yep.
And on Treasuries, this is surprising. Could we see another fall 20 to 25 basis points from where we are today?
I believe that we could, and the reason is it's going to be a classic risk-off type move where Treasuries benefit from a flight to quality demand or a flight to quality uptrade, and that could certainly run its course. You could see 10-year yields below 2% again.
And what about the dollar? Today we saw the dollar much higher, of course, against the euro and the yen, but that flight to safety, I guess, doesn't include the U.S. greenback.
No, probably not. I think that the target for the survey was 144, that range, if we actually did see another significant downgrade to the U.S. credit rating.
All right. What do you think, personally, is the likelihood of all of this happening? I mean, this is a big if. The super committee, November 23rd, is sort of the deadline we think of, but they may actually have to come up with a decision well before then.
Yeah, we're expecting that over the next week or so, the proposals and the behind-doors politics that need to happen are going to really have to pick up to get this deal through. And so we should start to get a better sense into next week if they're actually going to come up with a deal. If they don't come up with a deal, we could definitely see some support for the market, or for the Treasury market, on the uncertainty. I ultimately think that something does get done, but as S&P has warned, if it ends up being a watered-down version of what was promised by by Congress in August, then we might still see a downgrade. And again, that does have ramifications.
And today's reaction, we saw U.S. Treasuries rally quite a bit, of course, and we saw the U.S. dollar up almost, 3% when I last looked versus the yen. Let's talk about yen intervention. That's what we've called it here in the past. How much of an impact is that having on the markets, and you think that's going to be lingering?
Well, there's two aspects to the yen intervention. There's what it means to the actual currency, to the yen versus the dollar, and we focused less on that, but more on the ramifications for treasuries. So what typically happens is in this intervention, the MOF, or the Ministry of Finance in Japan, ends up with, it's estimated to be $60 to $70 billion to invest in treasuries. In the past, that's favored the 2 to 3 year sector, but increasingly with yields so low in that sector, we expect that those will be termed out potentially to the 5, 7, 10-year sector, which is some of what we saw in August. And so if that continues, that'll continue to weigh on Treasury yields.
All right, Ian, we got to end it there. Do appreciate your insight in the survey.
Thanks.
We shall see sooner rather than later, apparently. All right, thanks so much, Ian Lyngen of CRT Capital.